This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 13, question 12. Can you have a quick look with me? I don't want to spoil it, but just let me mention a few things. Part A, it says calculate special gift suppliers' funding requirement. Well, I'm going to give you handouts with all the written bits on, but just to remind you, funding requirement is the same thing. You can call it the operating cycle, or alternatively, the working capital cycle. So all three expressions mean the same. Oops. Funding requirement, operating cycle, working capital cycle. Can anyone remember what it is, please, in words? What do we mean by the operating cycle or whatever? Say again? Not just stock days. I'll tell you in words and then have a think when you come to it. It's the number of days or months. You can express it either way. If the question's given you in days, write the answer in days. If it's months, write the answer in months. But it's the number of days or months that cash is tied up in working capital. And so, although it's nearly spoiling this bit, but it's only 2 marks anyway, what we mean by that is if you're a manufacturing company, the first thing you do, you use cash to buy materials and you've got stock or inventory. And so cash is tied up in inventory until you eventually sell it. Once you sell it, the cash is still tied up, but in receivables while you're waiting to get the money in. And so, it's your inventory days, or months, plus your receivables days, or months. So you might keep enough inventory to last you 20 days. Cash is tied up for 20 days. You sell it, maybe on average receivables take 30 days to pay. So it's another 30 days, it's tied up for 50 days in total. You're all with me? The only thing that relieves that, in a sense, is that, of course, when you buy your inventory, you wouldn't normally pay for it immediately. There'll be a delay before you actually pay out the cash. Your payables days. And so that's what it is. I've said days, as I said before. If it's given you in days, do it in days. If it's given you in months, do it in months. That's no problem. But that's all we mean by it. So that's one thing. Think about it, read the question in a second. It has to it in part A. One other thing, though, to avoid wasting time. This question again involves factoring. But you'll see somewhere it refers to non-recourse factoring. Now, I know you weren't all here before, but can anyone who was here remember what is non-recourse factoring? Basic factoring, they collect your debts. You can have the extra bit, as I did, that they advance money early and charge interest. Can anyone remember what the extra bit is if it's non-recourse factoring you're paying for? Ooh. Yes, good Olga. Yeah, non-recourse factoring is where you pay extra to the factor, but in return, he covers you against bad debts. Non-recourse factoring, the company will have no bad debts. It's a bit like taking insurance. They charge more for the service, but they guarantee that you'll receive the money in full. They'll suffer, the factor will suffer any bad debts. The company won't have any. Okay? And don't look to the answer. The answer, the numbers are right. They set it out in a most confusing way. I'll have to get my screenshot. All right, can we have a chat? Because I think you've had time, well, you certainly all read it, obviously, and you should have had time to do most of the numbers. later today, not immediately, I'll give you another one to make sure. But part A is one of those things, if you remembered what we meant by funding requirement working capital cycle, that really was trivial. Inventory days, or here months clearly, receivables days, less payables days. If you hadn't remembered, then obviously it's a guess, but even so, I think that's trivial for 2 marks. All right. So currently, cash is tied up for 4 months, but is everybody clear there? Mm-hmm. He's mentioned it often. It could have easily been mentioned as part of a written. How long money's tied up for, and of course, irrelevant here, it was just a number. But for any written, surely any company wants to reduce that period as much as possible. Collect debtors sooner, be more efficient at handling your inventory, take longer with a reason to hold orders. Okay? Everybody. That was easy, part A. Part B is, like I was saying, some costs are a joke. I know it takes time to read, obviously. And face it, whether you found it here terribly easy or not, we'd only just spoken about it. In the middle of an exam, it seems harder. But it's very, very easy to get your half marks, even if 1 or 2 bits did upset. Shout if I'm missing any, but in any... Oh, sorry.
There is one of payment.
Oh, I'm coming. I'm sorry. Yes. So let's be patient. The easy ones, I think, but shout if you disagree. The saved admin. Everybody? No problem? What else? The saved bad debts. Now, some of you didn't notice or hadn't understood me. This was one little trick. Currently, the bad debts are 3%. The factor can reduce it to 2%. So had it not been for one line in the question, the saving would have been 1%, the difference. Yeah? But here, it specifically says, note 3, the factor offers a no-recourse facility. And he actually defined it, although I suppose you could interpret it different ways. But no recourse, I said before, it means the factor suffers any bad debts. We get paid in full. So the company will save the full 3%. All right, the factor has bad debts, but that's the factor's problem. That's why we're paying him. It doesn't affect the company. Is that clear, everybody? Factors do offer that service in real life. They'll check who you're selling to, clearly. They charge more as a result. But it's like paying insurance. But is everybody clear there? If they hadn't have had that line in, your saving would have only been 1%. Happy? What else? The factors charge. I know there are several mentioned here, and Eva's mentioned there's one problem. But certainly the easy marks. Note 4% of credit sales. Check my numbers, I think they're right. I hope any problem there is just arithmetic. The factor's interest charge. Now the answer is the most peculiar thing here, but gets the same net result. But I think far the most efficient, looking at it on its own. If they weren't giving us an advance, it says the factor takes, I've walked away, was it 1 month normally to collect? So normally, basic factoring, we'd have to wait 1 month for all the money. However, they're going to advance us 80% immediately. And so on the 80%, they will charge us interest for a month. So don't be shy, please, but I think my arithmetic's right. They're advancing 80% of credit sales, which are 90% of 2.5 million. They're charging interest of 15%, and it's for 1 month, because they're giving us 1 month early. So everybody happy with that one? Hello. Good. The interest saving on low receivables, a lot of people went wrong here. And in the middle of an exam, you're more likely to. But at the same time, you hit yourself if you missed it. At the moment, without the factor, how long is it taking us to collect receivables? Yeah, it's in Part A. That's the bit a lot of people in the real exam missed. From Part A, it's currently taking 2.5 months. And so current receivables, 2.5 months worth of credit sales. Has anybody checked my arithmetic? I think I've got the figure right. Employ the factor, and of course it's get it a lot quicker. With the factor, they pay us, is it 80% immediately? And the other 20% after 1 month. So with the factor, it falls on average to 0.2 months. And so the average receivables with the factor, 0.2 months worth of credit sales. And so again, that should have been okay, given what I did before, as long as you had spotted that bit from Part A. So there's the fall in receivables. It falls throughout the year. The company's paying interest at 12%. Again, are we all happy with that statement? Good. All right, what else? 3 other things, I think. First of all, it says somewhere, where is it now? Oh yeah, immediately below the notes, the salary of the sales ledger administrator would be saved. We've dealt with that. Also, though, overhead costs of £2,000 a year would have to be reallocated. Well, there was a mark, or half a mark, whatever, for ignoring it. Why is that irrelevant, please, about these overhead costs? Why is it irrelevant? And as I say, there were marks for not bringing it in. Yeah. We're reallocating. It doesn't say we're actually saving money. Presumably, the overhead costs in total stay the same as before. Charge them to whichever department you want. But all we're concerned about is whether costs in total go up or down. Is everybody clear there? That's more of an F5 bit. Another bit, which again I think just comes down to reading. Immediately above the word required, it says they pay their sales force on a commission-only basis. And the cost of it is 5% of credit sales. Again, that's irrelevant, and there were marks for ignoring it. Anybody, why is that one irrelevant? The commission. Why is the commission irrelevant? Say again? If you carry on reading, there's no intention to change this arrangement. So whether or not we employ the factor, we'll still be paying commission. There's no mention of sales changing. Obviously, if your sales were higher with the factor, there'd be more commission payable. But there's no mention of the sales changing. Therefore, you'll be paying the commission with or without the factor. It's irrelevant. All right? Correct? Yeah. So again, if you're being shy and you're still puzzling, in a minute, do ask me, please. But there were marks for ignoring those two. All right? Finally, I say finally, shout if you found anything else that's worrying you. But the one thing I've left out is note 5. A one-off payment of £25,000 is payable to the factor. Now, there are several ways you can deal with this. The reason you've got to think about this slightly differently, is that surely all these other costs and savings will occur each year. So you will save 67,500 a year. You'll be paying 90,000 a year, and so on. Whereas this 25,000 is a one-off payment. It's only going to be payable in the first year. Do you all agree? You with me, Inessa? And so, just to stick it in, and don't copy me, just to stick in 25,000 there, surely, is misleading. Because I'll add up in a minute. In the first year, you might lose money. In later years, you might gain money. You know what I mean? It's just a one-off. Well, there's several things you could have done. You could have put it in and said in the first year, this is the net result. But then in later years, a different net result. You feel what I mean there? Or, which in the middle of an exam I'd have probably done, would be just a bit of writing. I'd probably finish there and say, oh, there's a net saving of, I'm inventing the figure, let's say 10,000. But I'd then write down, there's a one-off payment of 25. So it really depends how many years I expect this to carry on. You with me there? Or finally, and what the answer did, which is quite neat, since it's a one-off payment and we're trying to get the yearly costs and benefits, what you could do quite neatly is say, well, there's a one-off 25,005. Because it's one-off, why not just bring in the interest cost each year? That this company has an overdraft and they're paying 12%. And to say, okay, make the one-off payment, your overdraft goes up. The yearly cost is showing the extra interest that would result. So now any one of those three would have got you the marks. But if you put in the interest on the one-off payment, it was 12% overdraft interest, wasn't it? And 12% on 25,000 is it 3,000? Now say, it's up to you. Any one of those three would have done. Either bring in the interest on it as at the yearly cost, or, as I'd probably have done, ignore it completely in your table, but then write an explanation below. Or, say, first year this, remaining years that. However, if you bring it in like that, what is the final? I may as well finish off the answer. The final result, 912, 115,500. 750, 1, 8, 10, 11, 1, 7, 8. I don't know if anybody's checking my arithmetic, but I get a net saving. Check my arithmetic, somebody. Don't let me leave up a wrong addition. Has anyone checked my additions? Is that right? Thank you. Is everybody clear about that last bit? Ever you asked me, I made you wait, but is it clear? Don't turn to it now, but I must tell you, as I said, the answer sets it out in a most confusing way. But the net, I said don't turn to it now, but the net result in the answer is everybody's turning to it. Look at it later if you're interested, but that is right. The net saving in the answer is the same, 16,250. But they've sort of muddled everything into one. They're right, but these things are weird. My way is much better. Not only does it get the right answer, but also my way. If any one bit goes wrong, there's obviously an examic card. You'd still get marks of the other bits. If you try and do several bits in one, you're just losing lots and lots of marks. Okay? All right, I don't know how many of you did look at part B, but just to have a check everybody's clear what it was asking. Part C, rather. And again, I know you've done lots of exams before, but trust me, I've read his comments. You can find them yourself later if you want. But it's always the same. Most people did A and B quite well. Apparently very few people did Part C. And that is completely stupid when there's 15 marks for Part C. Clearly, you can't pass on A and B alone, even if a miracle happened and you got every bit of Part A and B right. You've got to have done a reasonable Part C. And bits of Part C should be very easy for everybody. Again, not to get your half marks would have been awful. As an advisor to special gift suppliers, write a report to the financial controller. I said before, there'd be 2 marks for layout. You know, report, put a heading, to financial controller from. Never ever put your name, for heaven's sake. Put the name of the person next to you. How a credit control department might function. Well, you can read his answer yourself later and learn from it. But this wasn't technical. The credit control department, the department who's collecting receivables, all he wants is things like, you know, have regular procedures, as I say, send statements after a month, perhaps. Ring round chasing old ones after. Do you know what I mean? Read his answer, but that isn't technical. All of you, whatever work you do, should be aware of what we're doing trying to collect debtors. 3. So that should be easy marks. He's not wanting a lot, but anyway. The benefits of factoring. Well, effectively, I've already said it. Factor. They specialise in collecting debts, so hopefully, forgetting anything else, hopefully they'll collect better, so you'll get the money sooner, and hopefully there'll be fewer bad debts. Another benefit, you can reduce your own credit control department. You don't need your own people chasing if the factor's doing it. Less important, but do mention, if you pay more, they'll give you advances. They'll charge interest like they did here. And a final benefit, if you pay more, they will insure you against bad debts, which again could be beneficial. All right? So I say read his answer, but that little end bit, it's a bit of learning, but otherwise easy enough. Part 3 is the bit that's a tiny bit learning. I've given you some sheets and read my summaries later, but hello. What part 3 is getting at is, you see, forgetting all the numbers in the question, if you're giving credit, you can look at his answer, look at my sheet later. But if you're giving credit, if you've got receivables of, I don't know, 100,000 or something, the finance for that has to come from somewhere. True? You know, think about your balance sheet. You can't have receivables on your balance sheet of 100,000 without the money coming from somewhere. And there are 2 places you can get it from. You either get it from short-term finance, anybody, what would I mean by short-term finance in the sense of receivables? If I've got 100,000 receivables on my balance sheet, where are the 2 potentially obvious places I can get short-term finance for it? Say again? One is overdraft. Finance it by having a bank overdraft. What's the other even more obvious? Oh, that's not short-term.
Suppliers.
Yeah, payables. Surely the place any company is likely to get finance for the receivables from, it might take them 30 days to collect the receivables. Surely the company's likely to delay its payables. You understand me? Everybody? So, Clearly, you'd expect normally to use payables as effectively a way of financing it. More importantly, for this little bit of essay here, clearly, if you need, you could finance it from an overdraft. Alternatively, though, you could finance it from long-term finance. And although clearly it's a different bit of the syllabus, we'll chat about everything that goes with this later, but long-term finance is financing it from shareholders or long-term loans. Well, what he was really after here was this. Although there are arguments both ways, if I told you, on average, my working capital, inventory, receivables, less payables, if on average, for me, it's 100,000 throughout the year, then if I have a long-term need for working capital, any company, needs to offer credit and so on. If on average I needed 100,000 throughout the year, it would make sense to have raised that from long-term borrowings. Having said that, day by day, obviously, sometimes you need a bit more, sometimes you need a bit less, you would agree? Your receivables going up and down and so on. Well, sensibly, my average long-term need, I'd use long-term capital. The day-by-day fluctuations, this week I need an extra 10,000 or something, perhaps it'd be more sensible coming from short-term from overdraft. So that's really what he wanted. But the long-term average requirement is often called the permanent working capital, and sensibly finance from long-term finance. Now you're all sort of nodding wisely. If anybody's not clear what I'm talking about, have a chat to me, please. But your long-term average need, normally you would finance from long-term finance. Any short-term fluctuations. So I'm not being rude, but you know what I mean. On average, 100,000, but some days more, some days less. Yeah. The short-term fluctuations, which he actually refers to, he says what he wants to talk about. Fluctuating working capital. Perhaps more sensible. It's not a rule, but perhaps more sensible that you'd use short-term finance. I'll say again, if that makes sense, great. Otherwise, don't just learn a line. In a minute, speak to me. All right, that was a lovely question. I'll say it was your examiner.